Welcome to FYAP Securities 2026 Mid-Year Review. Overseas, President Trump's agreement to extend its ceasefire with Iran last April 22 towards June 20's agreement signing in Geneva for US-Iran peace accord lifted sentiment in US equities. The tech-laden Nasdaq had its biggest jump, up 13% for second quarter, as fund managers turned optimistic on AI prospects. The quickest manifestation was in global crude pricing as earlier supply concerns were pacified after vessels resumed their gradual passage through the Strait of Hormuz. Vessel crossings have improved to 25 per day from almost nil during the rift, while West Texas Intermediate has declined by 42% to $70 per barrel in June from its peak of $120 per barrel in April. Meanwhile, gold prices softened to $4,000 level since it hit its highest at $5,405 per ounce late January of the year. On monetary policies, the US Fed kept its interest rates unchanged with assumption of Warsh as the new Fed chair. Anticipating secondary effects from second quarter's oil price shock, however, the European Central Bank and Bank of Japan raised their benchmark rate by 25 basis points to counter inflation. A similar story occurred locally as the local central bank lifted key rates by a total of 50 basis points. The first was last April 23 and the second was June 18.
71% of 14 equity benchmark recovered, primed by South Korea at 101%. The main driver was the interest on tech-related stocks, on the heels of planned massive capex build-up in developing AI. Similarly, Taiwan jumped by 59%, Japan by 39%. Indonesia's declined by 35% as views over weak fiscal management led to MSCI index exclusion and the rupiah's weakness. Hong Kong also underperformed by 11% as a result of lock-up expiries in IPOs that created supply pressures. Meanwhile, Philippine performance was flat, with attention reverting to political headlines and inflationary pressure. More specifically, since its peak at 6,464 late January, the local market has gyrated within 5,800 to 6,100 since the signing of US-Iran peace treaty due to political headwinds, BSP's hawkish stance on interest rate and peso volatility. From a low of 57.57 peso to a dollar late February, the Philippine currency breached as much as 61.97 early May, a move that benefited exporters but weighed heavily on country's fuel imports. The color for the 254 stock all-shares basket was generally similar, 62% of which declined versus 38% gainers. There were a handful of standouts, primed by DHI up 438% given the stock's pivot to mining and BDO's sale of 70% block to Montesur equity holdings of the C Camp. Web surged 126% after Lance Gokongwei bought 10 to 15% stake in the firm. SGP climbed 78% on the stock's dividend payout plus regulatory clearances for higher transmission rate. On the downside, Ferro fell 49% after shifting its business model from lending to investment holding. Prim fell after BSP called for 669 million peso claim on a 1997 banking agreement with PDCP Development Bank, its former corporate identity. ABS ranked third among decliners, weighed by family spat among the Lopez camp. In terms of net foreign fund flows, January and February's combined 13 billion peso inflow was offset by March to June's 38 billion peso combined outflow. Much was driven by US-Iran conflict. Note, however, that net foreign outflows are starting to recede with the US-Iran peace treaty signing. This suggests most are still on cautious mode, especially with the ongoing political headlines at home. Despite the net foreign outflow in the initial semester, select pockets of buying remained visible. ICT drew in 12.3 billion pesos net foreign buying, followed by AC and APX as foreign funds saw value opportunities. On the other hand, JFC had 7.9 billion peso net foreign selling as operation contended with higher raw material input prices. The other large cap were weighed by portfolio repositioning, Ali, SM Prime, and BDO.
How did our first quarter stock picks perform? Bank selection was down by 7.5% overall due to expected NIM compression with slower growth in lending. East-West, however, was the sole advancer given its high-margin, consumer-centric business model. Consumer retail were also challenged as both CNPF and JFC faced concerns on discretionary spending. Both, however, have emphasized cost control measures for the remainder this year via raw material inventory hedging. Power Picks generated solid 20% growth, with ASIN riding on the excitement over renewable energy, while SGP attracted investors with its dividend yield and index inclusion prospect. REITs, meanwhile, were lower by 8% as investors gauged the impact of shortened work weeks and higher electricity costs on offices and malls. ICT jumped 57% on brisk prospects for global trade. Water utilities basket was flat, with Maynilad advancing on expectation for its index inclusion this August. Prospects of higher interest rates weighed on property basket, while lower gold prices affected interest for mining stocks. For our dark horses, conglomerates faced sell-offs with GTCAP being impacted by reduced industry demand for ICE vehicles. IMI advanced 15%, benefiting from spillover interest on AI and data center hype, while telcos muted as the market waited for regulations of the Konektadong Pinoy Act. For first quarter stock picks, Maynilad contributed 18% for its index inclusion prospects, while Meralco was flat on softer electricity demand. The selection led to an average 4% decline in sync with the market's broad trend. On the economy, we maintain our 3.5% to 3.8% GDP outlook pending release of 2Q GDP. Prospective upgrades will be based on the extent of investment build-up plans from some of the large cap names.
For the second semester this year, global risks include perceptions of durability of the US-Iran agreement, specifically on Iran's nuclear ambition abandonment, plus talks of possible passage fees along the Strait of Hormuz. Second is on sequels to the US tariff agenda that may spot select industries tied to electronic vehicles and semiconductors, and other geopolitical issues on the West Philippine Sea on China-Taiwan. From geopolitics, investors' attention could turn on geotectonics given the series of earthquake headlines. Meanwhile, opportunities abound for more sellers in the crude market that could temper inflation expectation. Also, the upcoming November midterm election might prod the Fed to go on status quo for now on interest rates. Lastly, Capex is building into generative AI. At the local front, debates are up on the Senate's hearing on VP Sara's impeachment trial. Expect political perceptions to gyrate as the investing community will be monitoring political governance policies. Next is environment-related, focusing on Super El Niño phenomenon that could renew calls for agri-imports. On local opportunities, interest is building for the debut of Vitro REIT and Mint in support for the fintech sector. Also, while expectations are ripe for a last 25 basis points increase in benchmark rate, a status quo is seen after this move. Should the status quo be upheld, that might prod investors to revisit large-ticket infra projects, part of which includes the PAC's Silica initiative in the north. Overall, our stance for the second half remains cautiously constructive. As long as inflation continues to moderate and geopolitical risks remain contained, the outlook for equities remains favorable despite elevated volatility. For index outlook, drivers for best-case scenario are cheap valuations, permanent peace agreement between US and Iran, and sustained momentum of possible sentiment upon the country's attainment of upper middle income status. Downside is at 6,000. For the second half strategy, the lineup covers defensive, real assets, and select dark horses. Banks and consumer baskets remain core to defensive positioning. The margin compression discount may start to wane as banks realign in favor of higher yielding segments such as MSME loans. Under consumer retail, CNPF, JFC, and Pure Gold are seen to benefit from improved discretionary spending. Renewable energy plays atop defensives. Aside from ASEAN, Meralco and Aboitiz Power are seen to benefit from improved generation capacities plus demand for power. Meanwhile, NGCP's 440 billion pesos capex pipeline would benefit SGP and strong barriers to entry from its infra investment. SGP may also get support for an expected February 2027 index inclusion. On REITs, upside angles are on improved occupancy and asset injections. Under real assets, property sector was a mixed bag, with modest strength in residential and commercial. Caution is still exercised for the premium residential category, yet demand is brisk for mid-horizontal. We added MEG given the stock's residential pipeline, plus strong office uptake. CPG is retained on its dividend yield angle and growth visibility from horizontal unit.
On mining, PAC Silica support for critical mineral-based exploration is positive for the sector. Also, the recent pullback in gold prices would be a good window for global fund managers to reallocate in this sector, given the greenback's volatility. For dark horses, we have replaced GTCap with SM, as the latter is seen to benefit most from consumption recovery. AC meanwhile has a good story to unfold in EVs and demand for IMI services. For telcos, debt reduction is seen for TEL post-Bito rate listing plus Maya's profitability. Converge on the other hand has a solid asset monetization potential with the AI investment push, yet we advise to wait on confirmation of its removal from the index before making entries. For second half top picks, SM has been added on expectation of recovery in consumer spending. The others have been maintained. Price actions are seen for TEL on Victor REIT's debut and Maya's story. Meralco may unlock more MGen's R backdoor entry via Spinec and Mterra Solar's 200 billion pesos solar initiative. And finally, Maynilad is expected to be included in the index, thus could unlock further upside.
Let's now head to corporate dynamics. Like June, ERC approved rules allowing qualified entities other than the national grid of the Philippines and power gencos to finance and construct associated transmission projects or ATPs, such as substations, switchyards, and connection lines needed to link new power plants to the grid. The goal is to reduce transmission bottlenecks and hasten the integration of new generation capacity, particularly renewables. To understand the implications, it is helpful to distinguish between two types of transmission assets. The first is the backbone transmission network, the major high voltage lines, inter-island links, and overall grid operations. These remain under NGCP's responsibility, and nothing in the new rules change its role as the national grid operator. The second is project-specific connection facilities, which are transmission assets required to connect an individual power plant to the main grid. These are the assets that third parties may now finance and construct. As a result, we view this policy primarily as a project acceleration mechanism rather than a dismantling of NGCP's monopoly. Instead of changing who operates the grid, the ERC is changing who can build certain facilities. When doing so helps bring new generation online faster. For SGP, the near-term earnings impact should be limited as NGCP continues to earn from its existing regulated transmission assets. Meanwhile, ownership of all transmission assets permanently reverts back to the National Transmission Corporation or TRANSCO at the end of NGCP's franchise. Note, however, that under Republic Act 9511, NGCP's franchise would end in 2059, enabling SGP to obtain dividends from NGCP.
PLDT's board approved pursuing a REIT listing for Vitro, its data center subsidiary, marking the Philippines' first digital infrastructure REIT. To recap, SEC issued revised rules expanding REIT-eligible assets to include data centers. PLDT filed with the SEC in June 2026 to raise up to 24.2 billion pesos, offering up to 1.9 billion common shares plus a 286 million share over allotment option at 11 pesos per share. The initial portfolio covers 8 of PLDT's 11 data centers with a combined capacity of 24 megawatts located in Makati, Pasig, Parañaque, Pampanga, Cebu, and Davao. Vitro REIT is targeting dividend yield of 5.8% in 2026 and 6.15% in 2027. Comparing it with other REITs, the move places Vitro on the 6th spot. Compared to other REITs, Vitro's conservative yield projection is indicated at 5.8%, placing it at the lower end of its REIT peers. According to a forecast by SGV assuming a price of 11 pesos per share, the company is seen to provide 6.15% dividend yield for full year 2027. Mint, operator of GCash backed by Globe, Ayala, and ANT, has filed with the SEC and PSE for an IPO targeted by fourth quarter 2026. The main issue, however, is that the shares are secondary, so Mint's expected capex plan would be key in terms of future funding needs. Nonetheless, the move would help raise retail participation, especially in advancing fintech. Thank you and see you on our next sequel update.